Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
M&A Unplugged community, we have a special treat today. I am being joined by Doug Adams, the owner of Emerson Capital, an SBA loan broker who specializes in helping buyers secure business acquisition loans. Doug works between the buyers and the banks and provides an invaluable service to his clients, the buyers. Doug works with about 18 preferred SBA lenders across the country. There are countless reasons to work with a loan broker versus going direct to the banks. We will explore those in details today. What I can tell you from working with Doug for over 10 years is that he understands the intricacies of SBA loans like no one else I have ever met. He provides tremendous value to his clients. He also happens to be my golf buddy and a great guy. Doug, such a pleasure to have you here today.
Domenic, thank you. Happy to be here.
So, Doug, we've been working together for over 10 years, and you've done, I don't know, God knows how many loans for buyers that we've brought to you. What I really want to get into today is the process that buyers go through and the things that they need to think about when they want to get in, business acquisition loans. So maybe we could start from there. When a buyer first comes to you, what should they be thinking about? What are some of the things that you talk to them about?
Well, I guess a number of different things. So initially, when I'm talking to a buyer, many times they are starting their search for a business. They have not identified a particular business yet, wanting to know, how to go about obtaining financing and will they qualify and what do they need and what do they need to have prepared. And then there are other situations where I come into the picture where a buyer has already sent in a letter of intent to a seller and they are ready to actually go into the process, get a deal over to a bank, get it approved, and try to close the deal. So on the situations where I'm working with the buyer before they've identified a business, I'll spend some time with them, find out their background, what their skill sets are, how much they have in liquidity, what are they looking to achieve in cash flow, describe how the SBA process works, what we'll need to put together, the tax returns, a personal financial statement, make sure their credit is adequate, and then determine how much that they can put down and leaving themselves some working capital. We can put working capital into the deal structure, which we can talk about, but the banks like to see that they have a little bit left over after they make that down payment. So based on their information, if they'd like, I'll go ahead and pre-qualify them as a buyer for a particular industry, given the fit that they may have with their background. Sometimes we'll work on a little bit of a transferable management experience narrative, which is an important factor for the banks to make sure that these buyers can step in and take over the specific roles of a given seller in a business. So we'll pre-qualify that buyer.
So, Doug, just to stop you there for a second. So pre-qualification, I imagine most people listening have gone through the process of pre-qualifying for a home. So it looks a lot like that, right? I mean, you're pulling together all of the relevant information so that you can figure out whether or not they could get bank financing and for what size deal and what type of deal, right? And those two things really matter. What size and what type, because you hinted here, relevant management experience, transferable management experience, really key thing for the banks, right?
It's huge. It's huge. And some of the banks, it's an outright requirement and they may want direct industry experience or not. And, it'll depend on what kind of rates you can get and structures you can do. But absolutely, it's very important. It is very similar to pre-qualification for buying a house. It's a little different because when you're going through that process of buying a house, they're going to analyze your existing cash flows. And here we're making certain assumptions about what the cash flows will be on the business you end up buying. And then that comes back to what is an average multiple on the cash flow. So since the SBA requirement in today's world is a minimum of 10% down from the buyer on the project cost, we can determine how much they can comfortably invest and then back into the appropriate purchase price. And then make the assumptions of how much cash flow is coming with that business at that purchase price, and then make sure, after allowing for what their household cash flow needs will be, that there's enough leftover cash flow to adequately cover the required debt service coverage ratios that the bank underwriters will look at.
Yeah, well, so you threw out a couple of terms there. We're going to come back and talk about those, but suffice it to say, the people that we have sent to you over the years are so glad that they've met with you even before they've identified a business. And I think that's really important because you've been able to help people think through what types of businesses they should focus on. Oftentimes buyers will come in and they'll be focused on a cash flow number that they want to get out of the business, or an adjusted EBITDA number, or broadly an industry, and they may not really be able to get a loan for that. And you're able to think through all of those issues with folks and maybe even steer them in a couple of different directions so they can then really launch a search, right? I mean, and we do that with a lot of folks. We'll have them start with you because you can give them a really good foundation from a lending perspective, so they're not wasting their time and bringing you deals that you can't get done for them.
Well, that's absolutely true. And to take that a step further, so once we can figure out how much they can adequately invest in a business, then we look to what do they really want to obtain in cash flow to live on out of this business. And if a lot of the buyers may not have already thought through, if you buy a business that has $1 million of cash flow, and let's say that purchase price for that business is $4 million. Well, that sounds great, but then you have to figure what is going to be the debt service on that business purchase after you structure it with 10% down and maybe a 10% seller note. So what are your payments going to look like to the bank? And if there's a seller note involved, adding in those payments. So then you look at what your expected total debt service is going to be. And on that $1 million worth of cash flow, you may very well use up $500,000 or $600,000 of it in debt service. So that what is your expected amount that you're going to take home? Is that adequate for you or not? And make sure they're thinking about these things in that regard.
Yeah. And so let's talk a little bit about, you're throwing out this term cash flow, and let's describe it a little bit more. So when you talk about cash flow, especially if it's an individual buyer and not a company, you're looking at what that business is going to spit off. And then you're also taking into account what are their personal needs, right? And so maybe you could talk a little bit about that. I think the term is global cash flow, right?
Yeah. So the banks are going to look at the cash flow from the business that the business is historically throwing off. And they're all about the pointing to the last taxable year of cash flow, because they feel that that's a third party verification of what the real cash flow is. And so they'll start with the net income in a given business. And then from there, they'll look at the appropriate add backs. And it's common for the banks to include and accept the add backs that are verifiable to get to what is commonly known as the seller's discretionary earnings. And those kinds of things, as you and I have talked about countless times, the seller's salary, depreciation, amortization, interest, things that the seller put through the business that either were one-time in nature or non-business related. And, depending on how big of a number that is, it may or may not have to be verified later. So they're looking at that cash flow that the business is throwing off. Now, as far as what the household cash flow needs are for a buyer, the bank is going to analyze that as well. And they're going to look at their mortgage payments, their car payments, any credit card debt, dependents in the household. And they're going to come up with what is, in their opinion, a minimum household draw that this buyer will need. Now, if that buyer has continuing outside income from a different source, or a spouse that provides income to the household, then that number can be reduced. And so if there is no outside continuing income, they'll take this available cash flow from the subject business, they'll subtract that household need draw, be it $75,000 or $100,000, and from what's left, they'll look at the coverage ratio on the debt service that is going to be as a result of this loan, debt service on the bank loan and the seller note. Typically, the banks are going to want the minimum requirement of coverage after allowing for that household draw is a 1.15, according to SBA rules and regulations. Most of the banks, however, would want at least a 1.2 coverage. And so So
and Doug, can you stop there for a second and just explain that calculation? How does somebody calculate what the debt service coverage is?
So what you do is you figure out what the loan structure is going to look like. And if you're buying that $4 million business and you're paying 10% down and the seller is holding a 10% note, what the resulting after the down payment in the seller note is going to be the bank loan. So that number, these are generally 10-year terms. Unless real estate's involved, you can get a longer term. But if that's $3.2 million, then you're going to figure what the loan payment is going to be on $3.2 million amortized over 10 years at 7%, let's say. And you can see what that payment is going to be. And you can do the same thing for the expected seller note. If that's being amortized over 5 years, at say 5 or 6%. And so you can get at what the debt service is going to be in this deal structure and then compare it to what the available cash flow is that this business is historically throwing off. After you take out that slice for the household draw from what's left, if you've got, let's say, $900,000 of cash flow out of that million that the business is throwing off because 100 went to the household, then how does that 900 compare to the 600,000 worth of debt service? And look at that coverage ratio.
Got it. And, some banks have different thresholds, right? I mean, some might have a 1.1, a 1.2, a 1.25, and what they include and don't include in the cash flow differs from bank to bank, right?
Oh, it definitely does. And yeah, so the minimum that the banks are allowed to push through to maintain their guarantee in these SBA deals is a 1.15 coverage. However, most of them are going to want something a little bit higher. And the ones who require, there are lots of banks that want a 1.5 coverage. A lot of the ones that we utilize are typically going to be in the 1.2 to 1.3 minimum. Generally, 1.2 is okay as long as the other components of the deal are satisfactory. But how they calculate that cash flow is also, as you alluded to, different for every bank. They're going to look at what the projected cash flow is for the business once this buyer or any buyer buys it. And so they should factor in the expected interest when they're going to look at the net income that the business is throwing off. Some banks will assess taxes on that. Like, what are the expected taxes going to be? And then they should, to take that a step further, how they're calculating that tax on the net income, or better, how they're calculating the net income depends on whether or not they take into account the non-cash expenses like depreciation, amortization, interest, and those kinds of things, and to get at what is the appropriate net income and then apply their tax on that.
And I think, Doug, what you're covering here is the very reason why we as a firm decided to have someone like you involved in the process, because every bank is different. The rules and their processes change, and staying on top of all of that is a full-time job. And so we tell people, when we refer them to you, that you've got 18 banks, they all look at these things differently, and that you can sift through, depending on the situation, which bank or banks are best for that buyer to be talking to, figure out where they can get the best loan and where's the highest likelihood of getting a loan. And that's the real value that I see in someone like you doing what you do day in and day out, is you keep all of that complexity in-house, and you're able to sift through that for buyers and get them the best outcome.
Well, there's no doubt, not all SBA lenders are created equal. And so all the banks have their own approach. They've got their own underwriting standards. As I said, some of them are going to require higher coverage ratios. Some are going to be more aggressive. Sometimes the more aggressive, and when I say more aggressive, I mean they're going to go ahead and approve and willing to do deals for a buyer who may not have an immediately identifiable tie to a given industry. So we have to do very often these transferable management experience narratives to connect the dots so that the bank underwriters can determine and illustrate for them that the buyer has the skill sets to take over the specific roles that the seller had. But there are many banks, especially over a certain threshold, will want to make sure that this buyer has direct industry experience. Now, those banks may have relatively lower rates, but you can't get a deal approved there if you don't have direct industry experience for a deal that's $3 million or more. Or they at a certain threshold, it requires more scrutiny and more people looking at it, and it's just tougher to get approved. So yeah, every bank has their own approach to identifying the coverage ratios to giving rates out, giving terms, and some can offer working capital express lines up to 350,000. Others will tend to put working capital into the deal structure, and there's different effects for either of those approaches. And you just have to know which bank is a good fit for a particular deal.
Yeah. And, over the years, we've even had some banks who have come to us in 1 year and have said to us, we want to do deals in this industry. And then they do a bunch of deals in that industry. And then 2 years later, like, okay, we're done doing deals in that industry, right? So the landscape just changes so
constantly.
Quickly, and the rates change and the terms change. And you heard cats all day long for your clients. And it's great because there's a lot of comfort in knowing that you can put them in the right place and get them the right deal. So Doug, let's move on from pre-qual. So somebody works with you, they get a good sense of the sorts of deals that they can get financed. They understand what their lending limits might be and their thresholds. They go out and find a deal and they bring it to you. What should they be prepared for from a bank perspective from that point forward? What sort of documentation? What does the process look like? How long does it take to actually get through the underwriting and approval process?
Yeah. So, one of the benefits of working with the SBA loans is that it's fairly standardized in terms of what the requirements are and the rules that all the banks have to adhere to. So when a deal is made and a buyer has found a business, or if I already haven't, I'll collect copies of their last 3 years' personal tax returns, a personal financial statement, a resume or a summary of their work experience, and then that coupled with an executed LOI, the 3 years of taxes from the seller, their present year profit and loss statement and balance sheet, I can go ahead and write up that deal based on the terms in the LOI and present it to a bank or to request a term sheet for the loan. So we'll go in and ask them to do a term sheet. And the bankers who I work with are all really good at what they do. Otherwise, I'm not using them. And so these guys are pretty experienced and they can look at these transactions and relatively quickly understand that there's a deal here or there's not. Assuming there is, then they'll issue that term sheet. It'll lay out the general terms and conditions for the loan, typically ask for their signature. Sometimes they'll ask for a refundable deposit along with it, maybe $2,500. Totally refundable if the deal is not approved. If it is approved, it counts towards their equity injection, so it's not a separate fee. We will then have them help them fill out a couple of forms, personal history form, and they will have already done that SBA personal financial form because that's one of the forms I give them. Then send that deposit, signed term sheet, the forms back to the bank. They'll be required to do 2 years of projections for what the business is going to look like under their ownership, starting from what the seller had for their last period P&L and making whatever line item changes are appropriate for what it's going to look like for this buyer to step in there. And then we'll put that together. If we haven't done a narrative on the managerial experience piece, and if it's required, we'll put that together as well and get it into underwriting. These are all preferred SBA lenders that I work with, which means they make their decisions in-house. Typically, it's 2 weeks or less in the underwriting process. The underwriters, once they get the file, they'll probably come back with a list of questions or requests, accounts receivable, agings, accounts payables, you name it. We'll get them that information. And then typically the bank will approve that deal in 2 weeks. They'll issue a commitment letter. The customer will sign it. They'll send it back to the bank. And then the deal will be assigned to a closer in the bank who will give us a closing checklist. And on there will be all the things that we need to get the bank in order to close the loan. Final purchase agreement. If the buyer is forming a new entity, they'll want the tax ID number, articles of incorporation, various types of insurance for the business. They may require life insurance on the buyer as part of the transaction. If the premises is being leased, they'll want to see the new lease or an assignment of the existing lease and make sure that they've got the legal right to stay there for the term of the bank loan. If there's a seller note involved, they'll want to see that. They'll prove up the equity that the buyers bring into the table. And they'll also order a third-party valuation during this closing process, which is the bank will hire that out and valuation company will come up with a value on the business based on the cash flows in the industry and the trends. And the banks are not allowed to lend more than the valuation amount. Typically, it's not a problem as long as the multiple is reasonable. And so that closing process, and the bank will do their searches and all that kind of thing too, is about 3 to 4 weeks. So if it's 4 weeks in closing and 2 weeks in underwriting, so say a week, but it shouldn't take this long to do the term sheet back and forth. So you're about 6 or 7 weeks in the overall process.
Yes. Let's talk about underwriting for a second. So what are the typical questions that an underwriter might come back with, and what's your process for handling that with the buyer?
So the underwriters are going to be looking at all of the buyers' financials, any debts that they have. Many times buyers own other businesses or other LLCs that maybe own real estate. Maybe they have rental income. Maybe they have another small business or a spouse that has a small business. So they're going to require the financials on any business in which that buyer owns 20% or more of the company, the taxes and financials, and they're going to factor that in. Is there any debt on that other business? Do they have multiple mortgages, to make sure that they're figuring out what their global cash flow needs are? So they're going to ask questions and get back up so that they completely understand that and whatever else the buyer is doing. On the subject business itself, they're going to sink their teeth into it. They're going to want to know what this business does, what the business model is, if the business model is, let's say it's an electrical business or something in which a company bids for jobs. They're going to want to know how that takes place. Who does the bidding? Who maintains the inventory? What are the roles of the seller that you're going to step into, the buyer's going to step into, and can he handle them? What are the receivables? What is the typical aging on the receivable? What are the working capital needs? Why did cash flow go down or up last year or the year before? They'll look at the expenses in the business, and if they see a wide fluctuation, they'll want to know what took place there. So they're gonna sink their teeth into this and really understand it. And we know that, and so that's why we prepare for those kinds of things, and in our summary and in offering memorandums, and try to give them as much of that information up front as possible.
And what about forecasts? How large of a role does forecast play in the buyer's overall picture and what the bank is looking at?
Yeah, well, so I think it's very important. And depending on the given transaction, if you have a business where every year the buyer's revenue is $2 million and every year their cash flow is $600,000, give or take 10, 15, one way or another, that's pretty stable. And so the buyer who comes into that, it's likely the bank is not going to be overly focused on the forecast because it's pretty evident that this business is stable enough to throw off those numbers. If you have a situation where the business one year has $2 million of revenue and the next year it has 3, and then the next year it has 1.5, they're going to get into it more and they're going to want to understand what is really expected going forward. So then it comes to what are these buyers' qualifications and skill sets, and what is his reasoning for believing that he can improve the business. Many sellers have run their businesses for years and don't do a lot of advertising or marketing or social media. We'll get a buyer who comes in and feels that he can increase this business nicely because of his existing skill sets in those areas. And so it's important to show that. And so we'll start with the seller's profit and loss, and we'll spread out, do a spreadsheet that segregates by month going forward for the first 12 months and look at each line item and determine, is that revenue expected to stay the same? Do you have reason to believe it'll increase? And if you do, by all means, we'll show an expected increase. What about the salaries expense? What about advertising expenses? Is rent going to stay the same? Are you going to have to add any employees? Factor in the proposed debt service and take away the add backs or the expenses that the seller had that buyer's not going to have. It's real important that the projections look appropriate. And if not, the underwriters will question them. So we spend a fair amount of time on doing those projections.
That's great. That's great information. Let's hit on one other piece in the underwriting that I think is important that people need to understand. You referenced third-party valuation. So can you talk a little bit about that?
Yes. So every business acquisition in the SBA world requires a third-party business valuation. It's a protective mechanism for the banks and the buyers to make sure that they're buying a business that is appropriately priced. It's not overpriced, and so they hire that out. It's a desktop kind of thing. They'll send the financials to the valuation companies, and there are companies that specialize in this, and all the banks use them. But there are a number of different ones, and banks use different ones, and some are maybe more conservative or more aggressive. But typically, they'll go ahead and take about a week and a half, 2 weeks, and analyze it all. They'll come back with some questions invariably on the operation itself and maybe, what the expectations are going forward, or question certain components of the cash flows. And they'll come back with that valuation amount. This takes place during the closing process after the approval. And so then the banks, as I mentioned earlier, are not supposed to lend more than the valuation amount. And typically it's not a problem. We have seen where the valuation comes in lower than hoped for whatever reason. And then you have some maneuvering to do. If the parties still want to do the deal, then they'll either have to lower the purchase price or increase the down payment or perhaps increase the seller note amount so that the bank loan matches up with the valuation amount. And that's happened before. And if there's a big discrepancy, the buyer can state why he still wants to buy it at that particular price, and we can send it into the SBA and get their approval. So it's just part of the process, and it happens concurrently with the rest of the closing process when the buyer's finishing their due diligence and we're getting all the items on the checklist.
Yeah, that's great, Doug. This has been awesome information. The thing that I would point out to people too is probably besides all of the hard work and effort that you put into these deals, the best news is that the buyers actually don't pay your fee. The fee is paid by the banks. So, and it's not an add to their loan amount. So it's not like it's being added in. Because you did all the work that you did and you brought that deal to them, they're paying your fee. So for buyers out there, it's very, very low risk to use Doug, and his services and the benefits are amazing. The comments that we get back from clients who have used you to secure their loans is unbelievable. They didn't realize how much work and effort and back and forth was going to go into it, and all the coaching that you can do to keep people out of trouble when they're in a deal is amazing.
Well, yeah, I think I agree with you there. And it is nice. I get the referral fee from the banks for bringing the deals over there, and I don't charge the customers anything. And it works well. And the best thing about this is, for me personally, I mean, everybody's in business to make a living, but it's so rewarding when you help these buyers realize their dream of owning a business. And so you take them through the process and they're excited, just like anybody would be in buying a house. And then when they close the deal, it just feels so good to help them get there. And that's what I do all day long. And it's just a really nice thing. And it works really well. And we've had fantastic success.
Yeah, it is pretty cool to see that. That is always one of the things about this business I try never to forget is how much fun it is to see people either sell their businesses and get paid for their life's work, this one big lump sum at the end of all of it, and then to see somebody new come in and have all that excitement about what they're going to do with that business. It always is very exciting. Doug, it's been great to have you on. It's been a while since we could get this scheduled. Any last comments that you would offer to the M&A Unplugged community?
Well, I would just say that, if you want to buy a business and you're interested in looking at whether or not you think you might qualify for a given size, give me a call. I'll be happy to talk about it with you. And, one of the things that I do with all of my buyers and clients is I'm happy to go through. Very often, as you know, these buyers are looking at multiple businesses, and it may take them months to years to find the right one. But as they go through them and they're analyzing them, I spend a fair amount of time with one, and I may have 25 calls or more with a given customer who is looking at different businesses, and we'll get the financials in and we'll look at, we'll analyze the cash flow and look at the add backs that are being shown here, and are they appropriate, and will the bank go along with them? And are you comfortable as a buyer with that? And then go through the structure and make sure that fits the criteria that they're looking for and the likelihood of it getting approved. So yeah, it can take a while, but the results generally are great, and it works out really well.
So Doug, how can people reach you if they wanted to get in touch?
So you can look at our website. It's www.emersoncapitalcorp.com. You can reach me at 773-368-9611, or my email is dadams@emersoncapitalcorp.com, and capital is spelled AL.
Doug, thanks so much. Pleasure to have you here.
Dominic, thank you for having me.
So M&A Unplugged community, Doug talked about a lot. If you're a buyer out there in the audience and been thinking about acquiring a business, really a great first step is to do a pre-qual. Sit down with someone like Doug and have him work through your background and your capabilities, not just financially, but from a good business fit perspective, which is critically important once you get to banks. And start there. It's a great place to really get calibrated on what a business search should look like. And then just from personal experience, 15 plus years of doing this, there are so many pitfalls in doing an acquisition alone, but then in the lending process, there are so many pitfalls. And having somebody like Doug, who's really a consultant for you to help you through every step and to keep you out of trouble and to keep your deal moving forward is invaluable. I can think of any number of stories where he came in and really kept the deal going forward because he knew where to push the right buttons and where to help the buyers. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.